Bitcoin didn't just dip in November 2025. It absolutely imploded. In October of 2025, we hit an all-time high of about 126,000 US dollars. On X and on Twitter, on the internet, whatever, we were literally saying that we were going to see a price of about 150K or even 200K before the end of the year. And this was just Q4 optimism. This was all Bitcoiners coming together, ready to ring in the start of the next cycle. But 6 weeks later, on November 21st, Bitcoin was trading at about 86,000 US dollars. I mean, that's about a 32% decrease in just a month and a half. So, what the heck happened? More than $1.2 trillion were erased from the crypto market. But here's the thing. This crash wasn't really about Bitcoin. It wasn't about crypto Twitter or liquidations or vibes. It was about macro. It was about institutions. It was about generational wealth. It was about a system that is literally mutating underneath our feet. Welcome back to the Orange Peel Podcast. I'm your host, Nicki, and I know these solo videos have been kind of missing for quite a while, and that is my bad. I have been so packed with exams. But that is all over and I am ready to go. I am ready back with these videos. I was doing my exams this month and I remember just like looking at the Bitcoin price and just being completely rattle-brained, looking at it every day and being like, what the heck is happening? And all of my friends were asking me about it. I have had so many people DM me on Instagram being like, what is up with the Bitcoin price? So I thought I need to finally sit down and I need to make a video. So today, that is exactly what we're going to get into. I'm going to break down exactly what happened in November of 2025, why the crash happened, and then talk about the part that nobody is really talking about. What the hell is Gen Z supposed to do now? Let's get into it. To understand the crash, you have to understand the setup. In early October, Bitcoin was totally flying. We were at that all-time high of about 126,000 US dollars. And it wasn't just because the retail traders were aping in. It wasn't the memes or the hype or the finfluencers. It was the institutional money. It was Wall Street. It was ETFs totally absorbing more than 1 million Bitcoin combined. It was hedge funds using Bitcoin as a macro lever. Bitcoin wasn't acting like this independent, rebellious internet money. It was acting like a full-blown integrated financial asset, a risk asset at that too, tied into the same systems as, say, tech stocks or bonds or the S&P, anything, your pick of the bunch, all of it. That mattered because it meant that when the macroeconomic environment shifted, Bitcoin was going to feel it immediately and very violently. So ring in late October, and this is when the first domino fell. The inflation data came in hotter than expected, with Treasury yields jumping back over 4.7%, which is absolutely insane. Suddenly, the dream that we had of rate cuts is completely dead. So the second that the market realizes that, every risk asset starts selling off. Tech stocks fell, high growth equities fell, crypto fell. Reuters actually reported that most of Bitcoin's November losses happened during the US trading hours. That same window when stocks were getting hammered. That means that it wasn't crypto bros or hodlers or normal people really panicking. It was literally these financial institutions de-risking their portfolios. Bitcoin was behaving like this macro-sensitive asset because that is what it has become. Then the second domino hit. ETFs flipped from buyers to sellers. The same vehicles that drove Bitcoin to its all-time high suddenly turned into massive sources of sell pressure. Across all spot Bitcoin ETFs, November recorded around $3.7 billion in outflows, just completely out the door. BlackRock's IBIT had its largest single-day outflow ever, $523 million on November 19th. And remember, ETFs don't sell exposure. They sell real Bitcoin on the exchanges into thin liquidity. Every sale pushes the price lower. This is where the structure of the market starts to crack. Now we get to the moment where everything completely unraveled. For weeks, everyone said $92,000 was the key support level. As long as Bitcoin stayed above it, we were going to be fine. But once it broke below that level on November 17th, the entire market fell off a cliff. By November 18th, Bitcoin dipped under 90,000 for the first time in 7 months. And that break triggered a massive cascade of forced liquidations. Millions of dollars worth of leveraged long positions that were wiped out almost immediately and totally automatically on Binance and, Bybit and OKX, everywhere. And when you combine thin liquidity with forced selling, a 10% correction instantly becomes a 32% crash. Bitcoin's price didn't just fall. It literally got pushed off the ledge by the structure of the market itself. But you know what? Even that isn't the full story. The last domino wasn't mechanical. It was literally psychological. Deutsche Bank, and forgive me if I'm saying that wrong, please correct my pronunciation, but they published a report calling Bitcoin's price dynamics the Tinkerbell effect. This meant that it holds value just because people believe in it. And once that belief cracks, even for a moment, it cascades into panic. By late November, fear took over once again. People started asking whether the bull run was dead, whether this was 2022 again, whether institutions were leaving for good. That loss of confidence, more than ETFs or macro, was the final shove that made the crash completely unavoidable. So what did November 2025 teach us? It taught us that Bitcoin is officially a macro asset. It moves with interest rates, liquidity, bond yields, and institutional flows. It also taught us that ETFs have become the dominant force in Bitcoin price action. Retail investors are tiny compared to them now. It taught us that liquidity is fragile and leverage is dangerous. But it also taught us that sentiment, that invisible force, matters now more than ever. This revealed something else, though. And this is something that is hidden and maybe not quite as obvious on the first glance looking at the crash. But it connects Bitcoin's volatility to the larger story of America's economy, and this is why I wanted to get into it. So that brings us to the real heart of this episode. There's a post on X that I read this week that has completely done my head in, and honestly, I haven't been able to think of anything else. And I'm going to link the post in the description, also add it here on the screen so you can pause and read through it yourself. But it explains the world that we are living in better than any macro research paper that I have read in my time at college. The post argues something simple but devastating. It talks about the generational wealth split that is the central organizing force of the next 20 years of American politics, economics, and asset selection. And here's the argument. America is not just unequal, it is locked. The biggest concentration of wealth in human history is held today by the least economically productive group, Americans over 70. They don't just have money, they own the entire asset base. They own the real estate, the equities, the bonds, the political donor networks, the zoning power, the pension capital, the philanthropic foundations, the trusts and the estates. I could go on and on. I mean, they own almost everything. And because they don't need to sell, they can sit on those assets for decades. Meanwhile, younger people like you and I, we literally can't afford to buy them. This is not a cycle. It is not boomers had it easier. It is a structural trap. It is a society where the young produce almost all of the economic output and the old own almost all of the financial claims that are on that output. I mean, it makes me actually heated just thinking about it. This is not capitalism, but this also isn't socialism. So it's really just this pressure cooker with one escape valve. And that escape valve is non-custodial, non-permissioned, non-political digital asset accumulation. Bitcoin is not popular with millennials and Gen Z because we're rebellious or edgy or we like having some, internet money that's popular on Reddit and Discord. It is popular with our generations because it is the only major asset where the 70 plus cohort does not already own the base layer. Everything else is owned. Housing is owned. Stocks are owned. Land, private equity, bonds, you name it. Bitcoin is the only vessel where younger generations can accumulate a meaningful claim on future wealth that is not downstream of older generation ownership. Not because it is perfect, but because it is risk free, because it exists outside this locked asset structure. And the wildest part is this: the US government knows that this dynamic exists. They can't confiscate the old asset base, though. They can't devaluate that boomer wealth. They can't, make houses magically cheap again. So instead, what they can do is quietly build new asset ladders. This means they lean into AI policy, industrial reshoring, fiscal stimulus, Bitcoin ETF approval, stablecoin integration. The system can't grow old ladders fast enough, so they have to create new ones. The system isn't collapsing, it's mutating, as I mentioned earlier in the video. And Bitcoin sits right on the fault line where that pressure gets released. So now that we understand all of that, the Bitcoin crash, the macro triggers, the ETF flows, the generational trap, the question becomes painfully real. What the hell is Gen Z supposed to do now? Here's the uncomfortable truth: we cannot climb those same ladders that our parents climbed, so just stop trying. We cannot wait for houses to get cheap. It's not a question anymore of whether or not you can buy a house. You can't. That's end of story. We cannot wait for those stock valuations to reset. We can't wait to buy the dip on land or bonds or passive income assets that 70-year-olds already own and will continue owning. Our wealth has to come from the new world because it's not going to come from the old one. It's going to come from the new asset universe that is being built right now, whether you like it or not. Bitcoin becomes this neutral store of value. AI becomes this new productivity engine. Stablecoins become the transaction layer between the two. And digital assets become this new frontier where ownership is still possible. This isn't hype, and this isn't financial advice, obviously. It is structural logic, though. It is saying that the younger generation cannot meaningfully buy into the old asset base. This is why we have to look to a new one. This is why we have to look to Bitcoin and AI simultaneously. We need assets that the older cohort doesn't control, and we need to start accumulating them. We have to build into this new asset base. And that is the real answer to what the hell do we do now? We stop trying to climb a ladder that's already owned by the people that don't need to sell. We start accumulating slowly and responsibly. Long term, we start looking at Bitcoin. We learn AI tools. We build skills that compound. We earn in digital currencies. We hold assets that we actually own. We need to position ourselves for the world that is being created and not for the one that is already full. Gen Z is not doomed. We are simply the first generation that does not inherit the old system. We have to build into the new one. And that's not weakness. That is just opportunity. So, yeah, November was hard. It was hard for you. It was hard for me. It was hard no matter, how many years you've been holding Bitcoin. It's not a good thing to, wake up and see the price keeps plummeting, unless, of course, you're super seasoned and you just think of this as buying Bitcoin on sale, in which case I commend you for your belief. But the crash was still violent and confusing, and honestly, just when you zoom out, it wasn't a crypto meltdown. It was a generational, macro, structural pressure release, just like a pressure cooker. If you're Gen Z, your path to wealth is not behind you. It's not in your parents' playbook. It's being built right now on new rails, on new technologies, on new systems, on Bitcoin, and on AI. That's it for this episode. I really hope that this was a helpful little explanation of what went down in November of 2025 for anyone who is Gen Z and watching this and maybe was a little bit concerned. I hope you feel a little bit better now. I know I definitely felt a lot better once I went and did my research prepping for this video. It is very scary at first when you are looking at the price consistently just going down. You see red, you see candlesticks, and you're like, oh my gosh, everyone told me Bitcoin was going to go up in Q4, and then it didn't. But once you do your research, hopefully once you watch this video, you feel a little bit better. So I really hope you enjoyed today's episode. Let me know in the comments what you liked, what you didn't like, if you've got any questions or just like leave a comment. Honestly, I love hearing from you guys, and I try to get back to them as much as possible. And with that, I'm going to see you next episode for something very, very special. I've got a incredible guest coming on, and I just can't wait for you guys to see that episode. Yeah. Until then, thanks for listening. Stay curious, stay skeptical, and stay orange pilled. I'm your host, Nikki, and I'm going to see you on Friday.